Welcome back, traders. Today we're breaking down a perfect example of why you shouldn't guess the market. You should read its structure. This chart tells a clear, logical story in 3 acts. First, we have our initial clue. Price failed to form a new lower low. This is the early warning sign that the prior downtrend is losing momentum and the sellers are getting exhausted. Then we get our confirmation. Price broke out of a recent structure level and made a bullish impulse move. This is the market shouting that the buyers have now taken control, aggressively pushing price higher and establishing a new trend. Finally, we have the entry opportunity. Price made a pullback and broke out of a subsequent 3-wave bullish correction. This is the healthy, logical retest of the new support level. Instead of guessing, we waited for this sequence of events, failure, breakout, and successful retest, to align. This is how you trade the structure, not the noise. Now let's take this a step further. The beautiful structure we just analyzed didn't form in a vacuum. Smart traders don't chase the move after the breakout. They wait for this crucial confirmation. What were we confirming? We were waiting for the market to show its hand after a classic case of liquidity manipulation. Look at the area marked liquidity below the final pullback. In the context of the prior bearish trend, this is where the market likely swept the lows, taking out the stops of weak-handed sellers trapped in the old downtrend. This liquidity grab is the market's trap. It creates a false sense of continuation, making everyone think the bear trend is still strong. But then the reversal happens. The failure to make a lower low, the bullish impulse, and the clean pullback we discussed earlier, all of this action occurs after that liquidity is taken. So, a valid setup always follows liquidity manipulation. We don't jump in blindly. We wait for the market to take the liquidity, reverse, and then show us a clear structural shift. By waiting for this sequence, you avoid the trap and position yourself in the true direction of the new trend. All right, so we've identified the structural shift and understood the liquidity sweep that set it all up. Now let's talk about the most critical part for your profitability: how to trade at a discount. Think of the market in 3 zones: premium, equilibrium, and discount. Premium is where price is overextended and expensive to buy. Our goal is to avoid that. We want to buy the discount, the cheap prices before the next leg up. So, how do we do this? It's a simple 4-step process that builds on everything we've learned. First, identify the trend. We've already done that. Our analysis confirmed a bullish market structure. Second, get in on the next leg up after a break of structure. We wait for that bullish impulse to break a key high, confirming the trend is still healthy. But here's the key: we don't chase it. Instead, we use a Fibonacci tool to locate the equilibrium zone, typically looking for a pullback to around the 50% level. This equilibrium is the fair value area between bulls and bears. Finally, and this is the golden rule, remember to buy at discount. This means placing your buy orders within that pullback, in the discount zone below equilibrium. You're not buying the breakout, you're buying the dip. This is how you get high-quality, low-risk entries while everyone else is paying a premium. You're not just reading the structure, you're using it to get the best possible price. Now, we're going to take our buying at a discount strategy and sharpen it with some precise professional-grade details. This is where we move from a good understanding to a great execution. The framework is the same. Identify the bullish trend, wait for the next leg with a break of structure, and always aim to buy at a discount. But now, let's lock in the critical nuances. First, after the break of structure, we need to locate the equilibrium with precision. The new detail here is to use the Fibonacci retracement tool more aggressively, looking at the 62% level, not just 50%. Why? Because a deeper pullback to this 62% level often represents a stronger, more significant discount zone where the market finds true value before resuming the trend. But here's the master key, the most important new step. Before you even draw your Fibonacci, you must correctly identify the swing you're measuring. The instruction is clear. Take the last major swing low that was formed before the breakout. This is the low that defined the prior range or consolidation. This single anchor point is crucial, because if you measure from the wrong swing, your Fibonacci levels will be useless. So, to recap the refined process: find the trend, watch for the breakout, anchor your fib tool to the last major swing low before that breakout. and then patiently wait for price to pull back into your discount zone near that 62% level. This disciplined approach ensures you're not just buying a dip, but you're buying the right dip in the trend, maximizing your risk to reward and truly getting the smartest entry possible. Now let's zoom out and look at the powerful engine that drives this entire setup: liquidity. This is the fundamental force that creates the explosive moves we profit from. Remember that discount zone we've been waiting for? Right below it lies a critical level: the early seller's stop losses. This is a key pool of liquidity. These are the traders who sold during the pullback, betting against the bullish trend. As price dips into our discount zone, it's also approaching this liquidity pool. When the market sweeps this level, it triggers those stop losses. These forced buy orders act as rocket fuel, creating a massive imbalance where buyers completely overwhelm sellers. This imbalance is the beginning of momentum. It's the powerful thrust that launches the next leg up, creating the very break of structure we wait for to confirm our trade. So understand this: we're not just buying a random dip. We are positioning ourselves ahead of this liquidity sweep. We're buying in the discount zone, knowing that the market's own mechanics, the triggering of stop losses, is likely to create the explosive move we need. This is the final piece of the puzzle: trading not just the structure, but understanding the underlying liquidity that makes the structure move. That we understand the role of liquidity, we have one final, critical filter to apply: evaluating the strength of the demand zone. Not all demand zones are created equal, and knowing the difference is what separates okay trades from great ones. Think of demand zones on a spectrum from weak to strong to stronger. A weak demand zone might be one that's been tested too many times, like a floor that's starting to crack. Each visit consumes buyers, making a break more likely. A strong demand zone is like the one we've been analyzing, a fresh zone created by a strong bullish impulse after a break of structure. It's a new level of buyer interest that hasn't been tested much, but a stronger demand zone combines everything. It's a fresh zone, and it's aligned with a key liquidity sweep and a significant market structure shift, just like in our chart. This is where you have multiple factors converging: the technical structure, the liquidity engine, and a clear imbalance. So, before you enter, ask yourself, is this a weak, strong, or stronger demand zone? By focusing your trades only on those stronger zones where structure, liquidity, and momentum align, you dramatically increase your chances of catching a powerful move. Let's talk about the ultimate real-world test for any supply or demand zone: how price reacts after it's formed. This isn't just theory. It's about how the orders of the big players are actually filled. The chart gives us a clear rule: a strong zone is one where price reacts almost immediately. Order fills happen just after the zone forms. Think about our setup: a massive bullish candle break structure, and then the very first pullback into that new demand zone is where you get your reaction. That's institutional buying happening right away. They see the value, and they don't wait. A weak zone, on the other hand, is one that price revisits again and again. If order fills only happen after one or two more price swings back to the zone, it means the initial demand was insufficient. The big buyers weren't interested the first time, which is a major red flag. So, how do we use this? It's our final confirmation. We've identified our discount zone using structure and liquidity. Now we watch. If price respects that zone on its first test, that's our green light. It confirms we are in a strong zone with real demand. But if price wanders in and out of it weakly, we know to stay away. This is how you filter for quality and only take the highest probability trades in the market. Let's flip the entire framework on its head and talk about the other side of the coin: how to draw supply zones. Everything we've learned about demand applies in reverse for supply. The goal is the same: to find high probability, low-risk selling opportunities. Just like with demand, a strong supply zone is created by a significant bearish impulse after a break of structure. You're looking for a clear shift from buying to selling. You identify the trend as bearish, wait for a pullback, a rally to a discount for sellers, and you draw your zone at the origin of that bearish move. The same rules of strength apply. A strong supply zone is one where price rejects it on the first test. It's a zone that forms after a sweep of bullish liquidity above a high, trapping buyers before a sharp drop. So, whether you're buying at a demand discount or selling into a supply premium, the core logic is identical. You're reading the market structure, waiting for liquidity manipulations to play out, and only taking trades where the zones show immediate order flow and strength. This symmetrical understanding of supply and demand is the final piece. You now have a complete logical methodology for reading the market, not just guessing it. Thank you for watching. This brings us full circle to the most fundamental concept in trading, support and resistance. Everything we've discussed, structure breaks, liquidity sweeps, and supply and demand zones, are all refined versions of this core idea. Think of support and resistance as the broad areas of attraction for buyers and sellers. These are the psychological and technical battlefields, often found at key Fibonacci levels or round numbers, where price decisions are made. A resistance level is a ceiling where selling pressure historically overwhelms buying. But as we've learned, not all resistance is equal. A supply zone is a specific high-probability type of resistance. It's not just a horizontal line. It's the origin of a sharp, bearish move that followed a break of structure. It's resistance with a clear narrative of institutional selling. The same goes for support and demand. A demand zone is a potent form of support, marked by a strong, bullish impulse. So, to tie it all together, master the basic areas of support and resistance. Then, elevate your analysis by learning to identify the strongest ones, the fresh supply and demand zones where the market structure has fundamentally shifted. This is how you move from seeing simple price levels to understanding the true order flow and momentum that creates them. As we wrap up this entire series, let's burn this final crucial slide into our trading psychology. Strong versus weak zones. This is the ultimate filter that separates high-probability setups from false hopes. The rule is simple but powerful. A strong zone is where the market's orders are filled immediately. Price enters the demand or supply zone and reverses on the first touch. This is the fast reaction that shows us institutional interest is truly present. They see the value and they pounce, creating the momentum we want to ride. Conversely, a weak zone is where the market seems indecisive. Price might wander into the zone, leave, and come back again. If the major order fills only happen after one or two price swings, it tells us that the big players, the smart money, aren't committed here. The energy just isn't there. So remember, your edge doesn't come from predicting the market. It comes from patiently waiting for the market to show its hand in these strong zones. You've learned to read the structure, identify the liquidity sweeps, and locate the discount. Now, apply this final filter. Wait for that immediate, powerful reaction. That is your true confirmation. Now that you understand the core of supply and demand, it's time to systemize your approach with the 5 rules for trading supply and demand. These rules are built around one key feature: the base zone, the consolidation area where the price base was formed before its explosive move. The rules are defined by what happens before the base and after the base, giving us 4 powerful patterns. RBR, rally base rally. This is the classic demand pattern. Price rallies into the base, consolidates, and then rallies out of it. When it pulls back to that base, it becomes a strong demand zone. DBD, drop base drop. This is the classic supply pattern. Price drops into the base, consolidates, and then drops out of it. A rally back to that base creates a high-probability supply zone. RBD, rally base drop. This is a reversal supply pattern. Price rallies into the base, but instead of continuing up, it consolidates and then drops sharply. This base becomes a powerful supply zone, indicating a failure of the prior rally. DBR, drop base rally. This is a reversal demand pattern. Price drops into the base, consolidates, and then rallies strongly. This base becomes a potent demand zone, signaling a potential trend reversal. By learning to identify these 4 base zone patterns, RBR, DBD, RBD, and DBR, you stop just seeing zones and start reading the market story. You understand whether a zone represents continuation or reversal, allowing you to trade with far greater clarity and confidence. Master these and you master the grammar of price action.